Inflation is fundamentally a regressive tax on currency holders, functioning without the requirement of legislation, public debate, or a signature. At its most basic level, this mechanism operates through fiat debasement. When the supply of money expands at a rate faster than the production of goods and services, the purchasing power of each unit of currency is diluted. Historically, this occurred through the physical shaving of silver or gold from coins. Today, modern governments achieve the same result by instructing central banks to create new money electronically. This structural shift was cemented on August 15, 1971, when the US dollar transitioned into a pure fiat currency backed only by government decree. Federal Reserve Economic Data, FRED, confirms that since this decoupling from gold, the dollar has lost approximately 98% of its purchasing power. What cost $1 in 1971 now requires roughly $50. A critical distinction must be made between economic symptoms and the underlying monetary disease. Common indicators such as supply chain disruptions, energy prices, or wage growth are merely transmission channels. The disease itself is the oversupply of currency. When data indicates that inflation is moderating, it does not imply a reversal of price levels. Rather, it indicates a slower rate of permanent erosion. For instance, the 9.1% peak recorded in June 2022 represents a permanent, irrevocable transfer of wealth from savers to the sovereign. Consequently, cash is not a safe asset. It is an asset class with a guaranteed negative real return. St. Louis Fed data indicates that between 2020 and 2025, the average U.S. household's purchasing power declined by over 15%. Holding cash in a system defined by persistent deficit financing is a process of invisible capital liquidation.
The execution of the inflation tax follows a specific mechanical sequence starting with fiscal policy. In fiscal year 2025, the U.S. government spent $7.01 trillion against $5.23 trillion in revenue, creating a $1.78 trillion deficit funded by issuing Treasury debt to primary dealers. The inflationary mechanism engages when the Federal Reserve enters the picture through quantitative easing, purchasing these securities by crediting bank reserve accounts with newly created money. Between February 2020 and April 2022, the Fed expanded the M2 money supply by $6.8 trillion, a 40.4% expansion. This represents the largest peacetime monetary expansion in history. Because there is a 12 to 18-month lag between money creation and consumer price increases, the resulting inflation often appears disconnected from its fiscal origins. This process generates seigniorage, which is the profit the government realizes from issuing currency. Each new dollar dilutes existing holdings, effectively transferring value from the private sector to the sovereign. This transfer is most visible in the real interest rate, calculated as the nominal return minus the inflation rate. During the 2020 to 2023 period, real rates were deeply negative. A savings account yielding 0.5% against 8% inflation results in an annual capital destruction of 7.5%. This negative rate environment is a deliberate feature of debt-saturated systems, as it reduces the real value of government debt without a formal default. OECD data confirms this systemic friction. From 2020 to 2024, cumulative inflation exceeded real wage growth by 8 to 12 percentage points. This gap represents a permanent loss for workers and conservative savers who remained in nominal fixed income assets while the monetary base expanded by 40%.
Institutional capital navigates debasement by deploying an anti-tax architecture, favoring assets whose nominal prices float with the money supply. While cash holders absorb the tax, institutional investors shift toward equities, real estate, and commodities. These assets possess intrinsic productive capacity, allowing revenues and earnings to be repriced upward. Notably, global central banks have accelerated gold accumulation, signaling their own assessment of long-term fiat purchasing power. This indicates a potential systemic fracture point, known as fiscal dominance.
With U.S. government debt at approximately 123.9% of GDP as of 2026, and interest costs projected to consume all federal revenue by 2036, the Federal Reserve faces a structural bind. Its dual mandate of price stability and maximum employment becomes incompatible when the central bank must act as a fiscal pressure valve to monetize growing debt. The downstream impact is a bifurcation of asset performance. During the 2020 to 2024 period, gold appreciated 74%, while cash and nominal bonds delivered deeply negative real returns. Understanding these mechanics is a prerequisite for professional portfolio construction. A baseline configuration must include assets with monetary scarcity or pricing power. For example, Treasury inflation-protected securities, TIPS, now offer positive real yields in the 1.5 to 2.0% range, providing a direct hedge against CPI erosion. Equities in businesses with high pricing power and real estate function as long-duration real assets that reprice alongside inflation. Ultimately, the inflation tax is a deterministic process rather than a random event. For the informed investor, a permanent allocation to hard assets and productive capital is the only rational method for preserving real wealth across a fiat monetary cycle.